Companies like BlackRock, hedge funds, even Grant Cardone have all made millions in real estate investing one way. But now they all seem to be shifting differently in 2025. They're pivoting hard, pulling out capital from their traditional plays, shifting into new asset classes, and rewiring their entire playbooks. Why? Because the game just changed. And if you're paying attention, you can win alongside with them. Welcome to the channel that completely flips a script on real estate, money, and mindset. I'm Rob Ragno, and I created Redefine You to do exactly that. Redefine the way you think and invest in real estate. And I've created the exact blueprint that you need to start building wealth in 2025 by playing today's game, not using yesterday's model. So if you click like and subscribe to this video, YouTube will automatically send you the updates every time we release one. And if I was you, I would pay close attention because what I'm about to release in this video is going to change the way you look at real estate forever. And if you want to get involved with the movement, click the link below in the description. It's going to get you access to my free school community. Now look, I created this free school community for investors just like you, so you've got a place to go and get all the free tools, resources, and lock in to a community with like-minded investors so you can shorten the learning curve to your path to success. Now let's not waste any more time. Let's jump into this video where I'm going to expose to you exactly what they don't want you to know. The big boys aren't leaving real estate. They're leaving the old model behind. Flipping luxury condos in LA or New York is just too risky. Building luxury short-term rentals in the hot markets is extremely saturated. Everybody's running from those. Buying Class C multifamily in rough cities, just too much turnover for low yield. Instead, the smartest billionaire players are all shifting into creative build-to-rent communities. This is a smarter cash flow play where they can not only exercise long-term rentals for stability, but also incorporate those mid-term rentals, which are attractive because of the new product that they're releasing. But here's the punchline. What they're doing now is exactly what they should have been doing this whole time. Let's do some math here. A $5 million property at a 6% cap equals a $300,000 NOI. When financed at 7% on 75% LTV terms, you've got a $3.75 million loan yielding about $300,000 a year in debt service. That's literally zero cash flow and having millions at risk. So they're no longer chasing sexy. They're chasing safe and scalable. And this is exactly how you can win also. Just carbon copy the same model by shifting your strategy into the cash flow markets and asset class that they're doing. Next, you're going to want to utilize creative finance strategies which outrun the current high interest market that we're in today. Leveraging tactics like subject to contracts, seller finance, lease options, or land contracts in today's environment is super lucrative because you're able to purchase real estate today utilizing yesterday's interest rates. This can give you an opportunity to lock in a fixed rate mortgage at 3% interest that was originated 5 years ago when the market was a lot cooler. This will give you an opportunity to purchase a property and take over an existing loan that was put into place a long time ago that's got a low interest rate, which gives you the ability to cash flow today. Utilizing the power of seller financing is what gives you the ability to create terms that meet your cash flow needs by exercising the equity that's in a property that the seller is trying not to pay capital gains on. This comes into benefit with you because you could slowly disperse the profits to the seller while not incurring high interest rates. Utilizing any of these strategies also gives you the ability to not have to wait around for bank approvals or lose to the competition while you're waiting to stack your capital or cash. This gives you the ability to get into properties effectively, efficiently, and creatively. This is exactly how smaller investors are getting into the market right now and are able to obtain cash flowing property. Additionally, if you utilize our signature POP method, you'll learn exactly how to get into real estate investments just like these without having to use any of your own cash or credit and walk away with a profit on day one. That means when you close that property, the same day you're going to actually walk away with a check from the title company rather than you coming in with a down payment. Now, if you want to learn exactly how you can do that, click on that link below, jump into our free school community where we give you the POP method guide. This is going to show you step by step how you can start acquiring real estate without having to use any of your own money or credit and profit on day one. Now look, I'm not the only one in the market that does this. I've just perfected it. And honestly, the big players have been using this tactic for years. They just hide it from you so that you don't steal their secrets and start building your own portfolio as quickly and as large as they did. And speaking on portfolios, this is exactly why the big players like BlackRock, Grant Cardone, even the big REITs are cleaning up house. And this is not just happening in the new construction market. This is happening all over the country where new operators jumped in in 2021 and 2022 when the market was rapidly increasing while we still had low interest rates. But when the interest rates hiked, it quickly flipped the script on their cash flow pro forma. So if you didn't have deep pockets, you weren't able to bail yourself out of the equity reevaluations. This is where the big players and the hedge funds would come in and swoop in, pick up properties at a discount. And you could do the exact same by using the same strategy. So start looking in markets that offer a Class A or Class B property that has these signs of distress or indications of poor management. In today's market, we're heavily focused on the following: Memphis, Indy, Pittsburgh, and Tampa, where these property owners have already given up and thrown in the towel, and we're still seeing cash flowing opportunities. The fourth trend that completely went bust: Airbnb. Most inexperienced investors were overpaying for property just because in that environment, when travel was up, the cash flow made sense. But now in this market where interest rates are high and inflation has not seemed to stabilize yet, people are refraining from traveling as much, making the ability to Airbnb a property nearly impossible. Looking at any market right now, if you just open up Zillow, you'll see a 30 to 40% increase of listings that are all furnished and they all look the same. Why? Because once upon a time, these were cash flowing Airbnb properties that no longer work. By taking one of these luxury, already furnished properties, you can convert it into a midterm or co-living rental, which is going to allow you to multiply the regular income that they were getting on Airbnb to now a steady stream of an amplified form of income by splitting it up into individual rooms for co-living or offering it to travel nurses or executives as a midterm rental. Typically, this style of rental yields a higher rate of return because of the duration of the contract, but it doesn't give you the instability of daily rentals or reliant on luxury travel. This is necessity-based rentals. These are the types of guests that you're going to get into these properties that typically stay between 60 to 180 days. And the rates that they pay are typically 30 to 60% more than a standard long-term rental. And the rates that they are paying are typically 30 to 60% more than the average nightly rent of an Airbnb, which can have inconsistencies in your calendar, leaving you fronting the mortgage when it's vacant. Co-living communities have become super popular since home ownership rates have been declining. Today's environment, a lot of people are accustomed to renting rather than owning. This creates a perfect opportunity to transform those Class B or C multifamilies into a community with amenities that attract a new type of renter. These types of properties, you can simply add amenities such as a pool, gym, sports courts, which gives the luxuries to the renters to not have to leave the facility in order to enjoy their residence. Now, the truth is, you no longer have to go buy 100 doors in order to increase your rent roll. All you need to do is improve these types of assets, increase the monthly rent on these existing properties, and watch your cash flow skyrocket from the old methods that no longer work. The opportunity that lies here for you is that these big companies and hedge funds don't have the infrastructure in place to manage these types of unique rental styles. This is where you can come into play, where you can run the operations and they fund the equation. This makes for a perfect synergy for you to lock arms with the big boys and finally scale up the ladder quickly. And the last secret that they don't want you to know, that they've been shifting their strategies from the hot markets to the boomtowns where the jobs are following. People no longer want to live in these high income tax paying cities such as San Francisco, San Diego, LA, New York. Instead, they're flooding into cities like Orlando, Tampa, Jacksonville, Houston, Dallas, San Antonio, Phoenix, Charlotte, Raleigh, Memphis, and Chattanooga. These are markets that are completely overlooked by the typical real estate investor. And these are also markets that are booming with job growth and tech infrastructure. This is where the big companies like Amazon, Tesla, and these chip manufacturing plants that are moving in because of the high internet speeds in some of these locations and the ability to grow and expand where land is still relatively cheap. And most of these cities mentioned are located in a landlord-friendly state. And this is exactly where those billion-dollar hedge funds are shifting their strategy to start buying these institutional properties in these markets that are supporting these 200+ unit apartment buildings. And this is exactly where you can get in right behind them and scaling your portfolio really quickly by focusing on that 50 to 150 unit properties. Now, if any point during this video you were distracted, go back and take notes, because everything that I've shared with you tells you that you don't have to create a new blueprint. you could just carbon copy exactly what the big boys are doing and replicate that into your business today. The billionaires aren't panicking, so neither should you. This should be your signal to stop using yesterday's model and start using today's strategies. These billionaire investors are all making big moves, and that's exactly how they became billionaire investors. So now it's your turn. Make sure you like and subscribe to this video so you can stay up to date with exactly what the big players in the market are doing, so you can carbon copy the strategy and become equally as successful. I'll see you on the other side.